Yeah. Can everybody hear me okay? Yeah. It's great to welcome you here this morning to the first in our new collaborative series, the new Masterclass series entitled Great Minds Like a Think. I would like to thank this opportunity to introduce Damien Rossiter. He's the Program Manager for the Centre for Insurance Risk and Data Analytics Studies, CERDAS, who joined us in March. We're delighted to have Damien on board to manage CERDAS, which is our Higher Education Authority Human Capital Initiative Pillar 3 Award, which we secured in Q4 of 2020. This, coupled with our ongoing activity in the space, really forms an exciting insurance at IT Carlow offering. If you have any queries in relation to this or any aspect of our offering here, please do not hesitate to contact either or both of us there. Our email addresses are on screen. It's also great to have Arvind Ravi from nSurely here, the CEO and founder of nSurely. nSurely are very exciting Insurtech, and it's great to have Aravind here this morning working with us on this side of the offering as well, but we'll touch on that later. Let Arvind outline his offering later in the presentation, but it's a great offering. I think you'll find it very interesting. I'll now hand you over to Damien, who's kindly agreed to MC the event. Damien, if you want to take over.
Thanks, Aidan. Good morning, everyone. Thanks for the introduction. My name's Damien Rossiter, and we welcome everyone to the first in our Great Minds Like a Think Masterclass series with Insurance at IT Carlow. Insurance at IT Carlow consists of the Insurtech Network Centre there with Aidan and the Centre for Insurance Risk and Data Analytics, CERDAS, with myself. We strive to be the collaborative innovation, education and research partner of choice to the insurance and financial services industry. With the Great Minds Like I Think Masterclass series, the classes are going to be typically 45 to 50 minutes long with 10 to 15 minutes for questions and answers afterwards. What we aim to do with this is just generate further awareness of insurance at IT Carlow. We want to interact with our stakeholders with useful and thought-provoking content. And thirdly, we'd like to generate feedback on masterclass content so we can better serve the sector and our stakeholders by directing module and course development in areas that are relevant to all our stakeholders. We'd ask that you mute all your mics for the presentation, and we welcome any questions for us as the master class speaker goes through the presentation. If you can pop those in the chat, and we'll pick them up at the end of the masterclass. In relation to that as well, we welcome any and all suggestions on future content that you would be interested in seeing in our masterclass series. So please feel free to pop these into the chat as well. As Aidan alluded to there, nSurely is an exciting, progressive Insurtech startup and collaborative partner of the Insurtech Network Centre in IT Carlow. It's a usage-based platform as a service insurance offering. Aravind and nSurely were the recent recipient of the 2020 Best Business Opportunity just at the Rubicon Centre New Frontiers program after successfully completing New Frontiers Phase 3. So without further ado, I'll introduce you to Arvind Ravi, the CEO of nSurely, who's been patiently waiting in the wings, and I'll hand you over to Aravind now. And just on that, I'm going to launch a poll there as well for you guys, if you could just put your answers in on that as well. But thanks very much, and over to you, Arvind.
Thanks for that, Damien. I will probably get started with mine. I'm just quickly going to share my screen. Can you see it now?
Yeah, perfect. Thanks, Arvind. You can see it there.
Great. So great. Glad to be here today. Thanks so much for the opportunity. Today, I look forward to sharing with you the learnings that we've had in the last 18 months of journey towards building nSurely. nSurely, in a brief, is a usage-based insurance platform. We help traditional insurers offer pay-as-you-go type insurance products in the market. And our central focus has been in terms of extracting insights in real time from the driver's vehicles without the use of any hardware-based devices. We're extremely focused on the smartphone-based data acquisition and providing insights through that. So I'd really appreciate if you can give your insights on the poll. It would be great to know the group of audience that I'm talking to today. I'm just going to give it a second to understand that. Great. So I think most of the audience here understand usage-based insurance, what it is, but I'll give a brief just for everyone's purpose. So UBI is nothing but insuring a vehicle by the mile or by the hour. So you have a set price, an agreed price by the per kilometer or per hour or per minute. That set price is calculated based on the usage. So you literally charge for the insurance after the driver has completed his journey. With that said, why should insurers care about usage-based insurance? That's the big focus. It's been making a lot of news, and it's no doubt usage-based insurance is a great value prop for the end users. But why should the insurers care? That's the big question, and that's what we're going to talk about today as well. First of all, it is no doubt that UBI is growing. It's been growing over the last 4 or 5 years in a very slow fashion, but it's projected to go really fast, 5 times in the next 6 years. And the smartphone-based, usage-based insurance market is poised to take a large market share away from it. To put into perspective the size of the UBI market, right? This is about 40 or 50 times the size of the entire Irish insurance market in general. So that's how exciting this is. So why should the insurers care? It's because most of these products are centered towards millennials, and it's centered towards fleets and commercial insurance products, which is largely going to come from the existing portfolio of customers that the insurers currently have. So it is going to carve away much of the market share from these insurers in this time. But the actual effect of this would be more profound in probably the years beyond this projected period, because of the increase in the mobility space in general. We don't have automated vehicles yet. We don't have fully automated vehicles yet. But beyond 2027, beyond 2030, there is all evidences that we will be transitioning to a mobility centered market rather than a vehicle ownership market, and there are early signs to prove that is the case. So the first 6 years will define who has the data, who has the infrastructure that has been tested and is ready to go in order to face this transformation in a commandable fashion. Imagine it this way: when cars were first being put onto the roads, when insurers had to look at cars where they've only been insuring horse carriages before that. So it's a similar transition, but at the next degree, or at the next level, because you're not just moving from horse carriages to motorized cars, but motorized cars to different mobility platforms, because these mobility platforms serve different types of customers, and they are driven by different people, and most often it's not even owned by a single entity. So that poses a lot of challenges in terms of understanding how we insure and how we rate these products. And adopting usage-based insurance today could be critical in order to survive this particular disruption that's imminent. One other thing that we are personally excited about is the use of alternative data. So if you look in general, for decades we've been collecting telematics data, but they've always provided us hindsight about collisions. How did collisions happen before? But these data have not been effective in terms of how do we predict these collisions. So in a way, they have been reactive and not proactive. And usage-based insurance will see the transformation in that regard. We will become more reactive in the way we handle the data, we'll be more proactive rather than reactive. So I've just picked out 2 examples to demonstrate how this would happen in real time. So we within our platform are using one of the traffic data source. So what you're seeing here is basically what would be running behind the Google Maps, the Apple Maps, Waze, or any of these mobile-based map solutions that you might be having. So what you see here, JF, is actually the junction frequency. It's a number that defines what is the traffic in a given junction at any point in time. This is one of the most important factors that defines how many accidents will happen in a 1 kilometer radius within this junction. So the traffic flow then gives us the perspective of what is going to be the accidents in an hourly basis even before the accidents happen. And this we found is one of the most important factors that have been useful for us. But we've also found other factors that may drive adoption of alternative data in real time. For example, traffic volume information is something that we are very much interested in. We've invested a lot of time on it. What you're seeing here is a very low resolution satellite image of a given junction somewhere in California. This was actually defined for a totally different purpose. This feed is for automated vehicles to study traffic volumes in order to better drive themselves in a given traffic condition. But these kinds of data will help us understand what is the likeliness of collision in real time. So the data such as real-time traffic data, the flow of vehicles, and the traffic counters and the weather parameters, these tell us how many accidents will happen at any point in time in a given geography. But traffic volumes will help us put perspective to that. How likely am I going to be in those accidents? So if there are going to be 5 accidents in a given square kilometer, how many vehicles are there in that square kilometer, and that straight away tells you what is the likeliness or the percentage of likeliness of you being in that collision. We see these kinds of data will give a totally new perspective about how road collisions happen in general, and this will drive the future of rating in general. One other factor that is characteristic or very useful from a UBI context is insurers will be well prepared for effects of induced travel. Let me explain what's induced travel first. Induced travel is just a change in behavior of a given driver or any group of individuals based on the availability of a new source of transport or accessibility to a new source of transport. Say, for example, if the price of a given source of transport drops to a significant amount, then larger amounts of people are going to be accessing that. If there was a new service launched in a new geography, there is more likeliness of many people adopting that. So immediately that has effect on the number of people that are on the roads. And induced travel in 15 or 20 years ago may have been because of very simple factors. Maybe there was a weather forecast and you had to stock up very early in a given time. So there was an induced travel for like 5 to 6 hours. Those were, it was very simple, very predictable, and it happened very rarely. But the mobility marketplace of present day is creating induced travel, almost artificially creating induced travels over the years, and it's the effect of induced travel is only going to be increasing in the coming years, and that has a profound effect on the risk of collision in general. I'm going to quickly demonstrate what I'm talking about when it comes to mobility market. So the mobility solution providers, whoever they are, they can be e-commerce service providers, they can be ride sharing, carpooling, so on and so forth. There are electric scooters and these vehicles. What their focus is to efficiently transport a group of people or a goods or a service from one place to another in the least amount of time possible and in the most eco-friendly fashion. So it's basically moving a lot of people in the same infrastructure in a reduced time, yet having a good effect on the environment, being eco-friendly, which means that we are transitioning away from IVs, which is what we know most about, EVs, which are notoriously difficult to predict in terms of risk because they are so low in number and they pose a bigger threat when it comes to near field collisions, especially intercity collisions. So we don't know how the transformation from IVs to EVs are going to be. On top of that, there are going to be KPIs for these mobility solution providers in terms of what is the time in which I provide this service. I provide this service to my customers. So there might be a time bound. There's a promise of time within which your food gets to you, and there's a promise of time within which there's a promise of space within that service. So convenience, efficiency, and eco-friendliness are 3 important factors for these mobility market. And in general, you have three different segments of the market. You can define it multiple ways, but there are three different segments of mobility market in general. There is the last mile delivery, or the 0 to 2 kilometer market. And then you have the daily market, the daily hiring, or the intracity hiring process, like the e-scooters to hired vehicles. So on and so forth. They are the 2 to 10 kilometers. Typically, these are solutions that are solving issues of transport, like carpooling, for example, a commute, the everyday commute. That's what they solve. And finally, you have the long range services. This would have been the trucks, the heavy load vehicles, and you can see the effects of EVs, electric vehicles, mostly profound in this market segment, and it'll drive down quite quickly after that. And automated vehicles are one segment that will disrupt this segment very quickly. So we already have three different KPIs dictating three different market segments, but then the available solutions are tremendous. We have between EVs and IVs, the mobility solution can choose for one. Between personal pooling and sharing, personal is like providing a personal service, or a pooling service to a group of people, or ride sharing service to multiple people with the same asset. And then you have hiring versus hailing, and this list can keep going. There are different available solutions to solve the problems, and not often these solutions are same. Not often the risk within these solutions are the same. So in a very rudimentary sense, if we have to say how many solutions will be there in a market, right? I'm going to say that we pick at least one from the segments of mobility. We pick at least one from measures of performance, and one from the available solutions. And we have a set of 16. And if we do a simple permutation, that's about 3,360 types of risks. And each one of them more likely distinct than other, if anything, may have slight similarities. This is just to understand what is the depth at which induced travel can influence the way in which risk is being evaluated in the future. This is already seeing a lot of effects, especially due to COVID. We've seen the amount of vehicles on the roads have dropped from a personal perspective, but then there are more people on the roads delivering your food, delivering your products that you bought online, and probably people transporting through their hired cars rather than their own cars. I don't want to mull too much over this, but what is important to understand is mobility solutions are transforming the way the risk on road generally is, and UBI will possibly give insurers a deeper perspective, a better perspective of this transformation of risk in real time, rather than depending on a year-on-year frequency of claims or year-on-year statistics to prove that information. Now I want to talk a little bit about the economics of UBI, how usage-based insurance will dictate the KPIs of growth, or the KPIs of the businesses. This is something that might be very interesting to many of the people who are in this hall today. So in traditional insurance, customer acquisition is often measured by the number of policies that were acquired, right? But in the context of UBI, actually, the insurtechs that are in the UBI game right now, they measure their success by the number of kilometers that they've insured. And that's a huge transition. And let me explain why. There's going to be about 129 vehicles in the market for UBI by 2027. That's all the vehicles that across the world that will be under a UBI scheme. The average premium per vehicle over the year will be between $1,000 and $1,100. That's the prediction as of now. But obviously, there will be a lot of people on the lower side of the spectrum, maybe $250 to maybe $3,000 or $5,000 segment. And there will be a race for the type of customers that the insurers are comfortable. It's very similar to the race that we have right now in order to acquire older drivers against that of younger drivers, a specific group of people, a specific occupation of drivers against another occupation of drivers. So right now, the trend in the market is to go for high mileage, single driver use cases. This would be the likes of taxi drivers. They typically do more than 20,000 kilometers in a year. So these are high mileage drivers. They give them the volume of revenue that they are looking for, the volume of data that they are looking for, but they are typically singular in portfolio. It's a single driver that's driving it most of the time. And it's also easier to acquire these customers because the cost of customer acquisition is extremely low. You can acquire these drivers at a platform level. So for example, Zego in the UK has partnered with Deliveroo for Deliveroo drivers. So that gives them access to n number of drivers working for Deliveroo. It's an easier customer acquisition strategy. And over the years, this market would get saturated, and it'll open up an extremely competitive, low mileage single driver market. So these are private vehicles owned by young drivers. They typically are predicted to do low mileage. They are doing intra-city travels. They are not doing many intercity travels. So these drivers are in the market for a very cheap solution, and there might be a lot of incentives to acquire these drivers, and there will be a lot of competition for this segment because of the volumes that they bring in. Even though they are individually low mileage, having a large market share within this segment would mean you have considerable amount of the UBI marketplace. Then the third category that is extracting a lot of focus on right now is the high mileage multiple driver segments. These are the go-cars and the carpoolings, the UCOs of today. So these are car sharing, ride sharing applications that are helping people hire by the day, by the hour, and this does multiple. This is the largest amount of mileage that any insurer can get. But the flip side is it's so hard to predict the frequency of claims because it is being driven by different customers. It is being driven, it's constantly changing. Within the same day, there could be 5 different drivers driving the vehicle. And this is the general context of how competitive the landscape will become in terms of customer acquisition. People will be more concentrated towards the mileage, but there will be a large focus on the type of customers who are driving these vehicles and the number of customers driving these vehicles at any given time. And second most important transformation will be in the frequency of claims. How do we evaluate the frequency of claim of a usage-based insurance product? This is something that many insurers that we even have a conversation with have a big question on, because this literally dictates the way they price their products, the way they approach this market in general. And there is a huge lack of data right now in order to make any rational predictions about this marketplace. But how is it going to transform the way insurers think about it? Is insurers will be more personalized in their approach. So the Insurtechs will have a lot of data because they are, for example, the Zego or the Buy Miles or the Covers of this world, they would have 20,000, 30,000 vehicles. They already have 20,000 to 30,000 vehicles tracked over the last 5 years, and this year alone they have doubled that amount. So they have a lot of data in terms of how do we create customer segments or cohorts of customers or portfolios of customers within a traditional customer segment. So there is already a more granular approach based on the customer segments. There is better information with the Insurtechs in terms of the geographical, demographical, and occupational data, and mostly in terms of the behavior of each of these segments. So a person in his 20s in Dublin going to work, commuting to work in his private vehicle, and he probably is a programmer, is a completely different portfolio than a driver who's probably a gig economy worker in the same age category driving somewhere in Cork. Right? This is a completely different cohort of customer, and both of these customers affect the frequency of claims in a very different fashion based on the type of mileage that they're using, based on type of mileage that they're doing, based on their driving behavior, the times of the day that they travel in, and all of that. So there will be a very granular approach. There will be a very personalized approach towards predicting the frequency of claims. So there'll be multiple segments in the within a traditional customer segment, and we can already see that happening in the UK or in the US, where there are more mature usage-based insurance products. And finally, the North Star for any insurer, the loss ratio. traditionally, in any insurance product, we've always had one way of looking at loss ratio, looking at improving loss ratio, which is what we can control, the pricing, right? The pricing is the key factor. If you price the product rightly, you can possibly control the loss ratio. There are multiple other ways, but the North Star is always the pricing. How do we control pricing efficiently so we achieve a better loss ratio? But for the very first time, with all the data that we have, we can predict road collisions in real time. We can be proactive with all the data that we acquire from these vehicles, and we can actually mitigate this risk from happening. We can actually reduce the number of collisions that are happening, so there is less overheads, and that way you can improve the loss ratio. There is already startups in like the Loop Insurance in the US, who's now an insurance provider, who have a very equitable way of pricing their insurance. They dynamically price their insurance based on the risk, but they look at environmental parameters. They look at the geography within which they are driving, the type of occupation that they belong to, and so on and so forth. And they predict road collisions, risk of road collision in real time, and they vary the price in real time based on that. There is Lemonade, which is now entering the same game, and they are looking to have a very telematics-based approach, or a very proactive approach towards their product as well. We can see in Europe there are providers like Greater Than EU. There's there are a handful of people who can do this as well. And in Ireland, our focus in nSurely has been towards prediction of road collisions in real time. In a short while, I'll show you a demo of how do we do that. But a large focus has gone into how do we extract collisions in real time, how do we mitigate the risk of collision happening in real time, so that can have a positive effect on their portfolio of books. So I'm now going to go into the challenges of enabling usage-based insurance in general. I'm not sure, Damien, should we go for that poll at this point? Take a bit of a break and go for that poll.
Yep, we can do. Yeah, we can put that in.
Sure thing. So it would be interesting to know what is the most interesting to you in terms of the economics of UBI. Of the three important factors, the customer acquisition, frequency of claims, and loss ratio, we'd be very keen to understand what would be the most important, or what are the areas that you might agree with, what would be the key area that you would care about the most in this discussion. That's it. I'm going to move into the challenges in enabling UBI. With all the discussion until now, it is quite evident that the biggest challenge in UBI is the infrastructure. How do we transition from a yearly premium that is insuring a given set of people with smaller segments of customers, smaller cohorts of customers, and transition to a by the mile or by the hour product, and the infrastructure is going to be the key issue here, and that's the theme that we have found out in most of the cases. There are some UX level issues which also add to this problem, but mostly it's to the technology side of things. First of all, the biggest problem is the throughput. Right? Telematics data providers right now, they're capturing about 25 GB an hour per vehicle. Right? Let's compare that to the spatial applications, geospatial applications that we use day to day, the likes of Google Maps or Apple Maps, or AR games like Pokemon Go, or any of these geospatial applications that we are very much famous. They upload only about 1.2 MB. And they are able to extract far more information. They're able to extract, they're able to deliver better user experiences in real time. And this is a huge shift in the infrastructure that is being deployed in telematics, traditional telematics providers versus the spatial applications. So first of all, the telematics data is largely hardware based. and the frequency at which this data is gathered is at a much higher frequency. So it's gathered probably every second, every millisecond, or at 20 times a millisecond, so on and so forth. So that adds up quite quickly. So within an hour, you have and the number of parameters you're tracking. So from the steering to the braking quality to the performance of the engines, to the battery percentage, so on and so forth. There are multiple parameters that are being measured by telematics data. Whereas if you look at spatial applications or a mobile-based application, they typically track between the orientation of the phone, the G-forces on the phone through the accelerometer and the gyroscope data, and the GPS, the typical geopositioning. So you can quite clearly understand the quality of data, or the granularity, or the frequency of data when it comes to telematics data is quite high and quite rich, and that adds up as a big problem when it comes to throughput. And whereas when you compare to the spatial applications, they can deliver better user experiences, they can deliver better adoption, but they don't provide a better quality of data. And there has to be a really good balance between both of these that has to be achieved. A usage-based insurance product is neither both. It is probably lying somewhere in the middle. And there's this big problem of battery being draining on the smartphone if it's going to be a smartphone-based product. So a UBI product is probably somewhere in the middle of both of these at this point in time. So right now, the telematics data, again, they only provide hindsights. So, and it's so hard to provide real-time models. It's so hard to run real-time models because you're now processing 25 GB of data every hour, and that is per vehicle, and you can multiply that by the number of vehicles. So the cost of running this even on the cloud could increase considerably. So real-time models are out of the question. There is no way that you can. So you always provide only hindsights, and there has to be a balance that has to be found between providing real-time insights and providing hindsight level insights. So the focus are definitely on the real-time insights as of now, by consuming very little data but providing useful insights. And the throughput will remain one of the biggest problems that has to be solved in order to enter the UBI market. But it's not as big of a problem given the technology advances that we've had in the last 5 years. This might have been one thing that would have been a big blocker 5 years ago, and that was a big blocker 5 years ago because of the non-scalable nature of clouds, cloud platforms, or infrastructure in those days, and to the level of advancement that we've gotten in cloud platforms today. So it is very much solvable today, but this is one of the biggest hurdles that the insurers will have to come over when they launch a UBI product. And the second big problem is the cost of technology in enabling UBI. So if you use a traditional telematics data, it costs about $30 a month per vehicle from the leading telematics provider. There are cheaper solutions. So there are solutions that even charge just $1 or $2, but they don't provide the quality of data that the insurer would be comfortable with. This state-of-the-art, the most used telematics provider, Verizon Connect, they charge about $30 a month per vehicle. And that adds up to more than $300 a year for a given policy. That's probably 7 or 8 times more than the average profit margin acquired in the US for a given policy. And it makes, at this point in time, the commercial sense of using telematics or these vehicle tracking products is largely questionable. And that could have been the reason, that is one of the reasons why telematics has not progressed a lot mostly in Europe, we could say, because of the cost versus the profit ratio is not quite making commercial sense at this point. The third important point is the adoption and the scalability piece. In order for UBI to grow beyond it, there has to be an adoptable technology. So the vehicle tracking technology is core to UBI, and it has to be designed in an adaptable fashion. So a customer should have least number of blockers when they sign into a UBI products. The simplest thing is to download a mobile application and just go online and get yourself a UBI product. But because of the reasons mentioned above, you might want to have a hardware device, but those hardware devices might have to be again designed for adoption. So it's so hard to have a hardware device connected to an OBD port if you're thinking about scaling to 1 million vehicles in the next 1 or 2 years. It is just not feasible to scale your product if there was telematics devices connected to OBD ports or other ports within the vehicle in itself. So it has to be built for adoption and has to be built for scalability. And one big problem to tackle would be privacy. The customers will have to always be under control of what data is being shared, and that is a huge issue to be solved. On a smartphone level, it's easier to solve. We have several trackers that can be switched on and off, especially in the last 18 months or so. There's a large amount of time and effort that's gone into making smartphone applications privacy centric by Google and Apple, and it's easier to achieve today rather than it was 2 years ago. But still, privacy will be one of the key focus of which will drive adoption and will drive the scaling of the product. The final part is data aggregation. Data aggregation, for the reasons that I explained in a couple of slides before, is going to be the hardest thing that you would that any insurers will come across. So your mobile batteries can drain by 20% if a UBI app ran for 45 minutes, and that's not efficient at all. So if we reduce the frequency at which we gather the data, then we can reduce the consumption of energy, but that'll actually stop the insurer from gathering any useful insights. So this is where machine learning and artificial intelligence comes into play. There has to be efficient levels of processing done on device. So there is not a lot of data that is transported. But at the same time, a lot of these processing has to be offset on the cloud as well. So it's important to think of a data pipeline that starts from the end user's client and device all the way towards the cloud and finally towards the insurer's endpoint. And the way we visualize this data for the insurer, that will also be one of the key factors. So in order to visualize these data to the end user, or the broker, distributor, or the underwriter, we need to have third-party support. And getting a technology that is interoperable, getting an infrastructure that is interoperable with third-party solution providers is going to be one big challenge that we see will be there in enabling UBI. With that said, I would love to probably give you a heads up into what we are trying to do at nSurely and give a short demo of what we have achieved so far. And probably we'll cover a couple of use cases beyond just UBI, how you can use the infrastructure or the technology behind UBI in a traditional insurance sense. And with that, we'll probably come to a close of this presentation. So nSurely is a platform as a service. So it's a bunch of APIs and SDKs that helps traditional insurers offer usage-based insurance. And there are 3 things we kept in mind and we are constantly thinking about when we designed and are developing this application. So first is ease of adoption. Second is cost-effective and insight, and third is being insight-driven. Ease of adoption is so critical for all the reasons that I mentioned about. We want it to be agnostic in the way we operate, so we don't want to have a preference of the way insurance is being delivered to the end user. So we designed a very agnostic system that primarily works out of a mobile application, but if need be, can plug into hardware devices, OBD ports, or telematics providers who are existing right now. And secondly, we wanted to reduce the cost as much as possible. We are right now 33 times cheaper than the leading telematics provider. It only costs about 75 cents per vehicle per month for us to for them to use all the APIs and SDKs that nSurely offers. And finally, we had a lot of emphasis on the insights we are providing to the insurers and to the drivers, and how that will make an effect in the scaling of the product, in the success of the product in general. First thing that we are very much interested in is predicting the likeliness of collision. How likely are you to be in a collision when you're driving in a road, in any given road, and what would be the severity level of this collision? So that is one key parameter. But we're also interested in delivering the insights that is required for scaling for the insurers. So we are constantly studying about the KPIs that are driving Insurtechs and the way they are progressing with their customer acquisition strategies, the way they are progressing with their analysis of frequency of claims. So we are constantly developing models and insight-driven packages which can also run in real times. They would just plug into the existing infrastructure and give the insurers all the insights that they are looking for. So every day morning when you go into the office, you can literally open up a dashboard and see how many vehicles are being driven and what is the projected loss ratio for this quarter, and how has the travels over the last 24 hours affected the loss ratio, and how has your customer acquisition KPIs affected because of that. So we are trying to find out all these interrelations that are happening within the UBI scheme because of the likeliness and the severity of collision and the number of people that they've acquired into the scheme. Right now, I'd probably give you a short demo of the nSurely platform. So we've built what we call a web-based demo, and it just is a simulation of a person driving from somewhere in Dublin to somewhere else in Dublin. In the default mode, we would actually have someone driving from the airport to Dublin Phoenix Park. Just give me 1 second there. So the simplest thing, the most important thing is the set rating per kilometer, right? So there's 75 cents. Right now we are going to say it's 0.75 cents per vehicle per hour for this, and it's 0.005 euros per vehicle. So yes, so I'm going to run a simulation right now, and this is going to simulate someone driving from the Dublin airport to Phoenix Park. And within this mobile application, we are tracking only the GPS at this point in time for this demo. We would obviously be looking to track the accelerometer and gyroscopic data in the future. Though we are capturing that information, we are not storing that yet. It's just to test throughput at this point in time. So we capture all this information, and most of the processing is offloaded to the cloud at this point in time to conserve the best user experience, to conserve the battery usage in the mobile app. So we have the lat long that we are updating in real time from on the cloud. We are evaluating the distance and time elapsed on the cloud, and we are even evaluating the speed at which the customer is driving on the cloud. So we are not using on-device processing even for speed tracking. We are literally calculating the rate at which the lat longs change in order to calculate. So that way we are efficient in the way we've designed. So the most interesting part in this demo is the way in which we predict the probability of a driver being in an accident. Right now, the probability of them being in an accident is 38%. And if they are in an accident, they most likely will be in an accident that will cause bodily injuries. It will not be fatal, but it will cause bodily injuries. So we are using environmental data. And we are using at least 84 different data points in order to evaluate this, but primarily they're all weather details and road condition details that help us understand what are the conditions under which the driver is driving right now. So it's asphalt surface that they're driving on. It's the max speed here is 60 kilometers an hour, and it's on highway. So we correlate all of these information, and we have trained this AI based on the historic road collisions. So we have looked at the last 15 years of collisions that has happened in Ireland, and we have trained the AI to understand what are the conditions under which a collision is likely to happen, and this is to change based on the hour in which they are driving at any point in time. And the interesting part is we have factored this risk that we've evaluated into the pricing. So the pricing that you're seeing here is not just a factor of the rate per kilometer that was that we initially input and the rate per minute, but it also is a factor of the risk score. So if the risk score reduces, the price of this product would reduce. So it's dynamically priced at 3 levels based on the kilometers you're driving, based on the minutes you're driving, and based on the risk at which you're driving. So that would have given you a probably better idea about how we are handling collisions, how we are predicting collisions at this point. Now I'm going to share with you a little bit about some of the case studies that we are keen to explore beyond the usage-based insurance context. First, let's talk about the background risk evaluation. In a traditional sense, in a traditional market, you've insured your drivers, you've given the policy, but then it would be useful for the insurer to know if the commitments made by the drivers were true. So an occupation that was mentioned by the driver may not be the occupation that he uses the vehicle for. So a farmer using a vehicle somewhere in the rural parts of Ireland may do less mileage. But if that is being used as a freight vehicle, a small scale freight vehicle, then it's important that the insurer knows this, and it is important the rating changes for this particular vehicle. And it would also serve as a good analysis for if the insurer wants to move to usage-based insurance or a mileage-based insurance down the line, what would be the effects of it. You can almost simulate the entire UBI model without ever offering usage-based insurance. This is one thing that we are very keen about right now. The pilots that we are in conversation with may involve some amount of background risk evaluation. So it would be a mobile application which does all that we showed right now. It would capture the information from the mobile phone, but it would just not provide insurance mileage base, but it would just track the data. And maybe we incentivize that, incentivize the driver for having this mobile application. So this is mostly for the insurer. There's not a lot of benefit for the customer, but then it gives the insurer a better perspective about their customers, their portfolio of customers. And because it's real time, now you can make better decisions between 2 different cycles of customer acquisition. Second use case that we are exploring is the gamification of insurance in general. And we are talking to few fleet owners in Russia, in Eastern Europe at this point in time, where drivers, fleet owners are interested in in incentivizing better driving for their drivers. So what nSurely does is it evaluates the risk score for these drivers, and it tells them, it gives them TOS, simple messages, which says there's a crosswind, please drive slower, the surface is wet, please drive, be soft on brakes, and so on and so forth. And if the driver compensates for these risk mitigation strategies, they can keep earning points, which they can redeem for a coffee probably, or some kind of these partnerships that might come around. At a private level, gamification can be done to reduce the frequency of collision or or improve the loss ratio by influencing the behavior of the drivers. So a behavioral change is one place that we are investing a lot in. We are not yet built a product that would serve this use case, but we are very much interested in this space. And with the right partner, we would probably see gamification of insurance as well on top of UBI at this point in time. But that's everything about UBI and nSurely's journey so far. But I'd like to have a quick mention about the journey that we've had and we've shared with the Insurtech Network Centre at this point. So all throughout the journey, since I guess April of 2020 or even before, Insurtech Network Centre has been pivotal in our journey. So they've helped us put ourselves in front of the right people at the right time. So we are not too early when we go meet someone. So having that context of meetings is very important, and I think they understand the market better than a startup like ourselves. So networking and putting ourselves in front of right people, INC has been pivotal. On top of that, we've had we come from a very technology background. There are our technical team would have worked on capital markets and in the banking sector largely, and coming into insurance we had to adapt very quickly. We had to have active mentoring. So Aidan and Damien have been very helpful in terms of our transition into the insurance market. It was great working with them in that regard. And most importantly, product validation. Every step of the way, we had someone to show the product to, who can find the right people who can comment on the product, who can comment on the progress of the product and what should be the next step. It was a great journey, and until this point, they've also helped us in our brand exposure, including this particular masterclass that we are doing. So I really appreciate all the work that was put into helping nSurely and enabling our journey so far. Thank you so much.
Thanks very much, Arvind, for that very exciting, very interesting presentation, and we're delighted to be working with you, especially Aidan there as well in the Insurtech Network Centre. We just have a few short minutes left for questions, and I'm going to pop into the first one that came along there, a very interesting one, Arvind, from Martin Kennedy. I might just try and summarize it, but I think the basic nub of what Martin is asking here is how, in terms of until you get a critical mass of data in terms of traction in the market, how will you account for behavioral aspects potentially of your data being heavily weighted either by early adapters, those that feel that they're being prejudiced in terms of pricing, or those that are just value seekers? Is there any way of accounting for that, or a way to kind of normalize the data a little?
Yeah, this is one of the biggest problems or the hurdles that we faced. I think it was about 8 or 7 months ago that we had faced this problem of not having enough data to the critical mass, as Martin has put it out there. But the strategy towards our data acquisition and our prediction per se is largely based on historic road collisions. So we are not looking at the behavioral data from the drivers. We are not looking at the driving behavior in general. So the first strategy for us is to predict road collisions without any of the driving behavior of the user, but rather at the environmental factors, the infrastructure level factors, and how external factors influence accidents. And there's a lot of literature out there that proves that the external factors have a lot more weightage towards the risk of road collision rather than internal behavior. Though internal behavior is quite significant, external factors have a large weighting towards this prediction. So we immediately looked at the resources that we have. In all of Western Hemisphere, you can easily find access towards historic road collisions. So if right now we are working on remodeling ourselves for California and Ohio, it's been very easy for us to get access to this data. That means that now we are not depending on the behavior level aspects, but we are depending on the real nature in which road collisions happen in general, which puts the customer out of the question, but rather the situations under question. And that's how we are mitigating that problem. But down the line, when we have that critical mass, or when we have a successful partnership with a telematics provider, we would be able to provide insights from behavioral aspect as well.
Good stuff. And then that's great, Arvind, thanks for that. And Jonathan Garrett there asked one then, excuse me, connected cars on the way. Will that remove the need for smartphone telematics apps, as the connected car data can be piped directly into the insurer's risk pricing platforms? Maybe your algorithms could suck in the connected car data. And then on a related question, then it says, have you patented your scoring model?
Jonathan, we've definitely not patented our scoring model until now. And one thing we are doing right now is we are being very agnostic with respect to our pricing. We provide the insights with respect to road collisions, right? We say this is how likely road collision, this person is going to be in a road collision. This is going to be the severity level of the collision. It's not the severity level of the claim. So we can't really say what's going to be the claim amount yet because we are not modeled out of that. So we are saying this is going to be the level of collision and this is how likely this collision will happen. And we are leaving everything after that, the rating systems, how this data feeds into the rating systems up to the actuaries who probably have more experience than ourselves in transitioning that data into a rating system that works for them. But we are definitely looking at a scoring model, rating model, but it's largely out of our context, out of our scope as well, because we are technology enablers. We want to provide as much insights as possible, but we wouldn't want to be insurers. We don't have the aspiration to be insurance providers as well. So it's a bit out of our context at this point in time, but yes. And the connected car question is yes, and that's the reason why we want to be very agnostic. Smartphone are a great way to get adoption, the early adoption, right? The first 20% of the customers. But then down the line, we'll have connected cars, we'll have fleets which are connected. We have connected cars already. And we are all even thinking about how we can plug into the Android Auto level or iOS Auto level. So we're working on application that can go right into the car, right? Extract the data from the car. And that's why our whole infrastructure is built agnostic. We don't prefer a certain way of distribution. However, for the reasons of adoption, we might suggest to go with smartphone applications in the early days.
Perfect. Yeah. And then Paul Murray has come back there with a couple of questions. The first, is there any GDPR issues associated with nSurely that you need to overcome?
I mean, GDPR, we have to fit to the compliance, isn't it? There's no way getting around the compliance. I wouldn't see it as an issue, but it's definitely a challenge. And we are working with the right partners who can help us navigate through the GDPR guidelines. But largely, we are GDPR compliant because the data that we extract is through the operating systems from the smartphone, or with the consent of the drivers. So the POCs that we are performing right now are GDPR compliant, and we'll obviously keep ourselves GDPR compliant down the line. It's a big challenge, but we have the infrastructure and the support systems to help us guide through the way.
And then Paula, a follow-up question then around the mechanics of it. But again, this might refer to your earlier answer where you're saying that you might leave it to the actuaries, but it's saying here, when does the insurance commence? Is it only while moving? How are parked vehicles treated? Does the insurance attach to the vehicle or to the driver? And are passengers covered by the insurance? Again, that might be a one. You might leave this as if it's up to the insurer, but I'll leave you to answer that, Aravind. So, what do you think?
So we have an opinion on this. We don't have an answer to this, but we do have an opinion on this. What would be the right route? We think the insurance will largely be connected to the vehicle than the driver. We might be wrong, but the trend in the market right now, currently, if you look at any of the insurtechs doing UBI, the insurance is tied to most of these providers. The insurance is tied to the vehicle. Right, vehicle is seen as the parameter in which you can have multiple drivers within the same vehicle. Our architecture as well supports the same. You can insure by the vehicle, and you can have many drivers using the vehicle. So the question about parked vehicles. So when we say UBI, it's not truly you pay per mile. There is a base premium, and you are signing a contract to be in for X number of months or probably even a year. So there is a base premium factor that is always there in any UBI scheme. So you're paying a very small amount, let's say 200 euros, 300 euros, whatever that is, right? So you're paying that base premium amount that keeps you insured when you're parked, when you're not driving. But this variable component, which is when you're driving, is the largest, would be the largest component. And I'd say it would factor for more than 75% of the insurance premium in general. But that's, again, our opinion based on the conversations that we are having and based on the research that we have done. This is still at a very nascent stage, and we remain to see what's going to happen.
Brilliant. Yeah. That's great, Arvind. I think that's sorry. Yeah. Yeah, Martin. Thanks, Martin, for that. He's just jumped on a call, and he's wishing everybody success. Arvind, thank you very much for that. It was brilliant to know, and we had again a good few requests for the recording of it. So we actually, Arvind has kindly agreed to allow us to record this, and we'll make this available again, Damien, for wider consumption. Then I know there's a few interested people that contact us directly to review the recording. Obviously, with Teams meetings and the way things are at the moment, there's a lot of conflicts. But no, that was great, Arvind, and it's been great. Working with yourselves from, as you said, for that period, and to see the growth, to be honest, the pretty impressive pace of growth that you've brought nSurely on from our very early conversations to now. Definitely one to watch, I think, into the future, and it'd be a great Irish success story if we can, develop out on the pace you've been developing so far. There is some really exciting conversations in play there, I think, with proof of concepts and stuff like that there as well. So we look forward to seeing that. Other than that, Damien has shared some upcoming masterclasses topics in this series. Great to have this on the go there with Damien in the Centre for Insurance Risk and Data Analytics Studies. We're very excited about this, and I think Aravind is a good demonstration of this collaborative effort. He's worked with both there. We're working with Insurtech, and he's been able to link in with us then on the CERDAS side of the house as well, which is great. Again, just link in with us, guys, at any stage if you want to find out a bit more about Aravind or the offer they have there. I think it's well worth exploring that. If you're anyway interested in that space, reach out to us. If Damien or I can't help, we'll find somebody who can. That's what we try to do, is try to connect people or with the right solutions. We look forward to having you at the next session, and thanks very much for your time.
Thanks, guys. Thank you so much.